70%. I at 1%-2%. 5007, 200 VIX 17. 4.40%. 1005001%. 50. 4876 00079, 500. TI 90 /KTKIM /CH N. Good morning, everyone. Let's start with a look at the market closes from last Friday. The Nasdaq Composite concluded at 24,836.60 points, the S&P 500 finished at 7,165.08, and the Dow Jones Industrial Average closed at 49,230.71. Of note, the VIX Volatility Index currently sits at 18.71, indicating that market apprehension hasn't fully dissipated. The 10-year U.S. Treasury yield remains elevated at 4.31%, the U.S. dollar index DXY is firm at 98.51, and the offshore RMB USD/CNH is trading at 6.8334. In commodities, WTI crude oil is priced at $94.40 per barrel, and COMEX gold is holding above $4,740.90. In the crypto space, Bitcoin is fluctuating around $77,912.76. From our core conclusions, the market is currently exhibiting a distinct divergence. Last Friday's U.S. equity performance encapsulates this perfectly. The Nasdaq index climbed by 1.63%, while the Dow Jones slipped by 0.16%. Concurrently, major A-share indices generally closed lower. This clearly indicates that capital is shying away from traditional economic risks and instead concentrating heavily on specific technology and growth sectors. Therefore, our primary market direction for today is to selectively go long on AI technology and energy sectors, with a 75% probability. The main capital axis will revolve around the AI computing power supply chain, energy stocks benefiting from high oil prices, and gold, which retains its safe haven appeal. Regarding global capital flows, we observe a continuation of the path from Asia to Europe and into the U.S. pre-market, with a 65% probability of this trend persisting. The strong earning potential in U.S. tech stocks, especially with the Nasdaq index hitting a new historical high of 24,836.60, will undoubtedly continue to attract global capital inflows. However, we cannot overlook the VIX index being above 18, which serves as a reminder that the market is not entirely out of the woods. Some capital will remain on the sidelines due to high oil prices and broader macroeconomic uncertainties. Breaking down the macroeconomic drivers, interest rates are a neutral to negative factor, with a 60% probability. The 10-year U.S. Treasury yield holding at 4.31% places pressure on broad asset valuations. The market has largely priced in expectations that the Federal Reserve will not cut rates in the short term, with focus now shifting to next week's FOMC statement. Any hawkish rhetoric could trigger market volatility. The DXY, or U.S. dollar index, is a positive factor, with a 65% probability. Stabilizing at 98.51, amidst global inflationary pressures and sustained high Fed rates, the attractiveness of dollar-denominated assets remains, supporting the DXY's strength. Inflation, conversely, remains a negative factor, with a 70% probability. Brent crude oil prices nearing $99.13 are the core driver of current global inflation expectations. Elevated energy costs directly erode corporate profits and consumer purchasing power, acting as a primary constraint on risk appetite outside the tech sector. Geopolitical risks are currently neutral. The market has largely priced in the direct conflict risks in the Middle East, with current oil and gold prices already incorporating this risk premium. The subsequent focus will be on whether the situation sees any substantial de-escalation. For core assets, U.S. equities are showing divergent strength, with tech stocks being the absolute core. Growth stocks, as represented by the Nasdaq index, show strong momentum with a 75% probability. Last Friday's robust 1.63% close sets a positive tone for the start of the week, with short-term support around 24,500 points. A-shares, however, are dominated by domestic capital, with cautious sentiment. A-shares failed to follow the rally in U.S. tech stocks, with the Shenzhen Component Index down 0.69% and the Chi-Next Index falling 1.41%. This indicates low risk appetite among domestic funds, with the market still consolidating in a bottoming region. Bitcoin's price stabilizing above $77,912 confirms active capital in the high-risk asset space, resonating with the Nasdaq strength and serving as a key indicator of market liquidity. In commodities, gold at $4,740.90 and WTI crude at $94.40 remain elevated, reflecting ongoing market demand for inflation and geopolitical risk hedging. A pullback in these prices is a necessary condition for a broad improvement in market risk appetite. In terms of